Good afternoon and welcome to this month's edition of Market Happy Hour. My name is Bill Bynan. I'm glad you can join us today. I'm noticing a number of you are just coming on to the presentation, and we're happy to take the time this afternoon to join us. We have a couple of housekeeping items before we begin. As normal, I have to share with you a legal disclaimer that asks that you don't reproduce or share the information without our approval. And today we are joined by our normal panel, which would be myself, my partner and our Chief Investment Officer, Lewis Johnson, Zev Abraham, our Director of Research. We have a very special guest today, Dr. Lacy Hunt, who's joining us from Hoisington Investment Management Company. We're thrilled that he's taking the time to join us today live from Austin, Texas. And we'll be looking forward to hearing his insights today on bonds. Also, before we begin, as always, we try to make this as interactive as possible. If you have questions, please submit them in the question and answer queue on your Zoom portal. We will try to get to every question that we can. If we run out of time or for some reason we happen to miss your question, we'll reach out individually after the presentation and make sure that we follow up with that. And then lastly, we asked if you would be kind enough to complete our exit survey. This gives us wonderful feedback that we have and take in as we're trying to make these as topical and meaningful for you in your planning process. So we appreciate your effort in doing that on the way out this afternoon. So on our agenda today, as I said, we're going to talk about bonds. Lewis is going to take the very beginning to set the stage of our thought process on bonds, kind of give us a refresher of the function of bonds and how we look at them in the portfolio, and really kind of give the nuances of how they work to set the stage for a broader conversation, more in depth with Dr. Hunt, that's going to give us some real insight on his views along not only today, but sort of how he's viewed them over his career. And with that, we'll conclude with our outlook on bonds as we think about that as part of our allocations for each of our portfolios. So Lewis, I'll turn it over to you, and you can educate us on bonds this afternoon.
Hey, thanks, Bill, and thanks everybody. I certainly appreciate it, and I speak for the whole team. We appreciate everybody making the time available to kind of walk through these concepts, because what we really try to do with these is bring you very important topics and important speakers, and we couldn't be more thrilled than to have a speaker with the gravitas and expertise of Dr. Hunt. So before we kind of get into his expertise and ask him to walk us through some of these topics on bonds, what I really want to do is just take a very quick minute and just talk about, big picture, try to set the stage for that. I mean, one of my personal favorite investing quotes is that, from Einstein, that says, you don't really understand something simply unless you can explain it to your grandmother. So with that context said, let's just talk a little bit about bonds. And I do believe they can be explained pretty simply. So one of the ways that I think about a bond is it's really kind of a lending contract, because it has a point where a borrower promises to repay a certain amount of money that gets sent back to the lender at the end of the term. Number one, and number two, there's an interest rate that you earn over the time, essentially for the right of that borrower to rent that money from its owner, the lender. So that's how we think about the contract of bonds, and it has those two aspects of its cash flows, and that's going to be important when we talk about the length of the maturity of that bond and kind of what implications that has. So that'll be important in a second. So if you think about this kind of bond as a lending contract, it really gives it an important aspect, which is that the investor does not have to buy and hold that bond to maturity. That bond can be, bought and sold in the marketplace. And the point we want to highlight is if interest rates have fallen from when that bond was initially issued or that lending contract was consummated, then that can actually result in price appreciation for the bond. And typically the longer the maturity, the higher the price appreciation, which is something that we'll talk about. And so what this does is this lends a kind of a total return or a capital appreciation aspect, which is a whole nother way kind of to make money in bonds, which is completely different from the stated interest rate on the bond itself. And we think this is a really important concept, and we're going to talk about it in a second. And this is really going to help lead into our conversation with Dr. Hunt. So if you think about what this means, for instance, in the market over the last 40 years, interest rates have fallen. And what this means is that the opportunity for profit for the bondholder is really twofold. Of course, is the stream of income from the interest. The second is that the longer that, say, lending contract is, then the higher that potential price appreciation can be, because it is a contract for that set period of time. And that is really what opens up that window for capital appreciation, particularly in the environment that we've seen over the last few years. And so what that really means is that what's critical for thinking about bonds going forward is what will interest rates do in the future, kind of rising or falling. And so we want to show you on the next slide what's taken place over these last 40 years. Well, this is the result of that fall in interest rates. So this is the total return for bonds of 3 different maturities. The first is actually the highest, sometimes called the strip of the U.S. government 30-year bond, and that is that principal repayment that comes at the very end. So that has the longest duration. This has had the highest return. The second highest return over this time period of these 3 bonds is the U.S. government 30-year bond with a 30-year maturity, and that is both the income stream and the repayment. And then we contrast this with kind of an index of the total return of 5 to 10-year bonds. And you can see that this has been a good time to own all these bonds, but the one that has had the greatest return has had the longest duration. And the reason why is what we demonstrate on the next slide, which is that interest rates have fallen. So this shows 2 things. This shows interest rates on 30-year bonds from 4 sovereign governments: Germany, US, Japan, and Switzerland. You can see they're all down over that time period. And remember, this gets back to the point, like capital appreciation has resulted because those bonds are 30-year duration lending contracts. And because interest rates have fallen, investors can buy that bond at a higher price than when it was first issued and still earn a more competitive interest rate than that which or equal interest rate to that which prevails in the market. And so it's really those 2 aspects that drive the total return of bonds. And we really wanted to highlight this because I think oftentimes as investors think about these bonds, it's an aspect that they don't put enough time to. So I don't really want to, monopolize this time. Everybody didn't call in and dial in to hear and see me as Dr. Hunt. So let me turn it over to him. We couldn't be more excited.
Yeah, I'll give you a little background, Dr. Hunt. First of all, thank you again for being here. For our participants today, Dr. Hunt is the Executive Vice President, Chief Economist at Hoisington Investment Management Company. He has led a wonderfully prolific career, internationally known, award-winning economist, 52 years of experience analyzing the markets that we're investing in. Executive Vice President, as we said, of Hoisington. Hoisington manages over $5 billion of assets. He's authored 2 books. He served at the U.S. Federal Reserve under 2 Fed chairmen beginning in 1969. And like Lewis, he holds an MBA from the Wharton School in the lovely city of Philadelphia. Dr. Hunt, I believe that's why Lewis is such a fan of you, is he brags about his Wharton MBA. So 2 peas in a pod. So.
No. I first came across Dr. Hunt's work in 2010. I believe we were reminiscing about this the other day, where he made a presentation in New York that I was present and was really blown away by the thoroughness of it. Found it was uniquely insightful and well-informed, and I've been following everything the man has written, which you can find at Hoisington Management. And in my opinion, he's by far the smartest bond investor and observer in the world, which is why we're thrilled to have him today. And he's got a Wharton MBA too, which doesn't hurt.
So Dr. Hunt, we'll turn it over to you. I know you want to kind of set the stage with the discussion around GDP. So we again thank you for being here, and we're looking forward to hearing your insights.
My pleasure. Thank you for having me. The main problem that we've been dealing with here in the United States now for more than 2 decades, and is the same problem that the world is grappling with. We're all excessively over-indebted, and this indebtedness is detracting from growth in a very significant way. And every time a problem comes along, our solution is to try to solve the problem by taking on more debt, which aggravates the problem. And the $5.75 trillion that we borrowed in the last 15 months is going to have an extremely deleterious impact. It's going to force a prolonged period of low interest rates. and greatly cap economic growth. And this pattern is well illustrated in the first chart, based on the data itself, as well as some serious econometric work, almost 24 studies done around the world. The U.S. economy was basically carrying too much debt in order to achieve its historical growth pattern by the late 1990s. And on this page that you're looking at, the blue line is the trend rate of growth in real per capita GDP from 1870 up until this dead inflection point there in the late 90s. And that was approximately 2.2% per annum. And the black line is the growth that we've actually achieved since then. And you'll notice in the second quarter, the per capita GDP in the US was about $66,000 per person. If we had maintained the 2.2% rate of growth, it would be 23% higher. And this is why the demographics are deteriorating. This is why we're not having babies and forming families, why the demographic problems are more acute overseas than in the United States. And it explains why the real risk is not the inflation that we're currently experiencing, but disinflation and possibly even deflation. And unfortunately, there is no practical way to reverse the problem, because we keep repeatedly trying to solve an indebtedness problem by taking on more debt, and we exacerbate the problems. And that's the basic underlying fundamental difficulty. Let's go to the next chart. Everyone is very concerned over the fact that the inflation rate is currently high, and a lot of fine folks are extrapolating substantially a continuation of this substantial inflation. However, that's, in my view, not going to happen. Now, looking at the money supply growth, last year we did have a very serious surge. There was an integration of monetary and fiscal policy like we've never seen before. However, the Federal Reserve's liabilities are not legal tender. They're not a medium of exchange. They can have a transitory impact on the economy, but it fades very, very quickly. And if you look at the inset chart, which is the 3-month rate of growth, the M2 growth has come down to about 5.25%. It's decelerating sharply. And in the meantime, the other critical parameter, the velocity of money, is falling very sharply. Let's look at the next chart. The velocity of money is derived from the equation of exchange, which says that GDP is equal to money times velocity. You perhaps heard the famous statement by the Nobel laureate Milton Friedman that inflation is always and everywhere a monetary phenomenon. Many people remember that statement. It's given a great deal of coverage. But Friedman was very, very careful in terms of his mathematical work. And he made it clear that statement was predicated on the assumption that the velocity of money is stable, which it was in the time period from the early 1950s to the early 1980s. It was not a constant. But for example, in the 1970s, money supply increased 10% per annum, velocity was stable, so nominal GDP increased 10%, which was the fastest peacetime era of growth in the US economy in terms of nominal GDP. When the banking system was deregulated in the early 80s, we had an initial spurt in velocity, and velocity rose. And what we were witnessing there is the law of increasing flat and then diminishing returns. So if you take a factor of production and you begin to increase it, initially economic output will rise. If you continue to increase that factor of production, the economic output flattens out. And then if you still insist on overusing debt capital, then the rate of growth begins to fall and eventually may turn negative. And notice that the velocity of money followed that pattern. And in 1997, every dollar of money was creating $2.20 of GDP. And it's been in a major downturn. And the velocity of money now is at an all-time low. Out of every dollar of money, we're only creating about $1.10 of GDP. And this reflects the over-indebtedness. For debt to work, it has to generate an income stream to repay principal and interest. And when you don't do that, then the velocity of money falls. And then this tends to emasculate monetary policy. And so the point that I'm making is the transitory growth in money supply last year has passed. It's being reversed, and the velocity of money is still trending lower, which means that the economic growth rate has already peaked for this year. The third quarter will be weaker than in the second quarter and the first quarter. The slowdown in economic growth is actually beginning to cut into the inflation rate. It's still very high, but the reason that we're beginning to see an inflection point in the inflation rate is that the economic circumstances are getting ready to deteriorate on us. And this will have very broad repercussions. And the pattern is very similar around the rest of the world, only more so than in the US. Let's look at the next page. This is the indebtedness situation. We can look at total debt going back to 1870, non-financial debt since the 1950s. You can see where we stand. Both measures are at all-time high. We've had 5 major debt bubbles in the history of the United States. The first was in 1838, the next in 1873, then the 1920s and 30s, then 2008, 2009, and now we have another debt bubble in 2020. What is different about the debt bubble in 2022 is that it occurred only 12 years after the prior debt bubble, and not the typical 40 or 50-year lag. And so we didn't unwind the indebtedness that occurred in the late 1990s and early 2000. And in fact, we've gone to new higher debt levels.
Dr. Hunt, would that be the equivalent of saying we shouldn't have solved the debt problem with more debt?
We cannot solve it with more debt. Yeah. As a matter of fact,
that's the trend, at least has been.
We keep trying to do the same thing over and over again, and the results get worse. Japan has been trying this now since the late 1980s. Europe has been trying it for 2.5 decades. Europe is more indebted than we are. Japan is more indebted than Europe, and now China is massively over indebted. Where they stand in the rankings is hard to say, because there are a lot of data inconsistencies, but China is extremely over indebted. In other words, there is no pocket in the major economies of the world that are under leveraged or moderately leveraged.
Dr. Hunt, if it's okay, I'm gonna interject with some questions that are coming in and kind of make a little bit of dialogue. We have a question in from Alex, and Alex asks, how do you think about the economic impact of technology in terms of disinflation, deflation, as well as improving productivity and its effect on growth?
Well, that's a great question. The production function has technology in it, along with the factors of production, the capital, natural resources, labor. And technology could help us. It has worked for us in the past. However, the technology that we're experiencing today is different than what we experienced during the great period of economic growth. And I would recommend that Alex read The Rise and Fall of American Economic Growth by Dr. Robert A. Gordon of Northwestern, a book that was published a few years ago. And Dr. Gordon looked at the great period of economic growth between 1870 and 1970. And what he observed was that technology was revolutionary. And the technology enhanced the demand for the factors of production. For example, the transmission of electricity. We had to build the electric grid. Think of all of the raw materials and labor that went into that. The combustion engine, modern sanitation, pharmaceuticals and chemicals, and communication. The technology that we're experiencing today is more evolutionary. It does not enhance the demand for the other factors of production. It's wondrous in many ways and changes a lot of aspects, but it does not enhance the demand for all of the factors of production. Great question. Let's go on to the next one. Okay, you want to talk about this graph. This is well worth doing. This is the debt situation in the US versus Europe and Japan. Notice that the green line has moved up substantially, but Europe is 100 basis points higher than we are, and Japan is 293 higher. And the fact that Europe and Japan are more over-indebted than we are, we can see that their economies are lagging the US. Let's look at the next chart. I'm sorry, you didn't put that one in. I'll just have to describe it to you. What's happened, if you go back to the establishment of the European Union, we were about 4% larger than Europe and about 98% larger than Japan based on real GDP. We're now more than 200% larger than Japan and 35% larger than Europe. The reason that Europe and Japan are lagging the United States is because they're more indebted. And although there have been many predictions that the dollar would fall, the dollar is held in the top 15% of its value since it was floating in the early 1970s. And the reason that it holds its value is that although we're not on the right path, Europe and Japan are in a worse situation. The next chart shows one of the deleterious consequences of over-indebtedness. When economies become extremely over-indebtedness, the risk premium rises, which is the possibility that a borrower will default on his loan. And when that's the case, the banks find it very difficult to pass through the risk premium to the potential borrowers. And so what happens is the loan to deposit ratio falls. And the loan to deposit ratio is in fact a lagging indicator. The red dots on the chart indicate where the loan to deposit ratio is at the start of the recession. The blue dot is the cyclical low. If you look in the upper right-hand corner, you'll see that the loan to deposit ratio lags about 47 months. And right now we're at an all-time low and heading lower. The banking system is in basic disrepair. And the reason they are is because we've taken on too much debt. And we've driven the nominal interest rates close to the zero bound, and the velocity of money keeps falling, which means that monetary policy's capabilities are basically asymmetric. If the Fed wishes to tighten conditions, raise interest rates, that will work, but they don't really have any bullets in their arsenal that can do much other than for a very transitory period of time, such as we saw over the last 12 months.
Okay. Dr. Hunt, I got a couple of questions that are kind of similar from Don and from Ken, and I'll kind of combine them. Could enough fiscal and monetary stimulus, and from Ken's perspective, $3.5 trillion of infrastructure be large enough to create inflation? Could a large enough living wage paid to each person in the US create inflation?
Basically, when you engage in these debt financed operations, they only lift the economy for about 3 months. For example, you may remember the shovel-ready projects of '09, debt financed. We had one good quarter, another one fairly good. If you go back and study the debt finance tax cuts of 2018, the second quarter of 2018 was a very fine quarter, but then the growth rate turned lower in the second half of 2018, decelerated all the way through 2019, even though the Federal Reserve was cutting interest rates. When I was in graduate school, I was taught that the government multiplier was 4 to 5. It is now negative. And so the benefit from the debt financed activities is confined to about 3 months. And then the debt becomes a burden and it drains from growth. If you will remember, you can find many, many forecasts when the $2 trillion package was passed in March after the $1 trillion package at the beginning of the year. Wondrous things were projected for the US economy. And it produced a good first and second quarter, but that growth rate is fading away now. And the problem will become more serious as we go forward because of the indebtedness problem working its will on money supply growth and also on the velocity of money.
Okay, question in from SJ. It says, won't the asset bubble persist if rates continue to stay low? At what point will the cash flows disappoint? And he followed that up and say, for now, companies are reporting record earnings. We're not seeing the economic sluggishness and impact of profitability at this point.
I think that we will see it. For example, if you look at the projections or the tracking of, say, the Federal Reserve Bank of Atlanta, they're showing about a 4% rate of growth in GDP in the third quarter. However, when you study the numbers in detail, all of the growth is an improvement in inventories and an improvement in the trade deficit, small improvement in the trade deficit. The final sales in real inflation adjusted terms, I think, are either flat or negative in the third quarter, and they will be weaker in the fourth quarter. If you look at the high multiplier big ticket sectors, which would be housing, automobiles, capital equipment, and plant equipment, plant construction, they're all negative. You simply cannot run this economy over the retail counters.
Well, and Dr. Hunt, I would ask you, if you think about the prior slide that shows the level of our level of over indebtedness, which is of course a new all-time high for us, which is lower than Europe and lower than Japan. I mean, to me, that's always spoken very, very strongly. And I remember that was one of the points that you made back in 2010 that struck me very strongly, because of course we were just coming out of the other side of the global financial crisis, and there was a tremendous amount of stimulus taking place, and everybody was predicting inflation. And I think you at that time, rightly pointed out that Japan has been doing, then it had been doing that for 20 years, I guess, and now they've been doing it for 30 years. And we're going down the same path, doing exactly what they did, and we're not getting any kind of better response, but yet our policymakers are continuing to go down that path.
We're really in a serious trap. The Bank for International Settlements calls it a debt trap. The debt is undermining economic growth, and then to try to get us out of the problem, we take on even more debt, which makes the situation worse, not better.
So what is the cure?
Right, yeah.
Well, one of the leading researchers of debt problems is McKinsey Global Institute. You go on their website and read their 2010-2015 studies, and they looked at these 24 advanced economies that became extremely over indebted in the time period between 1900 and 2008. And in all 24 cases, it had to be solved by what McKinsey called austerity, which is a sustained and significant rise in the saving rate. In other words, getting more indebted is living beyond your means. To correct it, you have to live inside your means. But here is the problem. If you go toward austerity, that causes short-term weakness. Long-term, it would be healthy, but it causes short-term weakness, and no one's willing to tolerate that. So politically, none of the major industrialized democracies have the capability of tackling the problem. And so we just fall back on doing more of the same with worse and worse results.
And
So
would
does
you
that
say,
eventually get forced on us somehow? The austerity?
I'm sorry, say again?
Does that somehow get forced upon us somehow by just the economy, shrinking to such a degree?
Well, yes. Take for example, we became extremely over indebted in the 1860s and 1870s. And it was building the railroads, the industries that fed the railroads. There was massive speculation. There was overliving, overconsumption, overinvestment. The panic year was 1873. Grant was president. He had no idea what had happened to him, basically. Neither did his advisors. We were on the gold standard at the time. We had no central bank. And the absolute view was that the government must balance the budget. The late MIT professor, Charles Kendallberger, said that this was an example of allowing the indebtedness to burn itself out. In other words, the market just handled it. And we did have deflation for almost 2 decades, but the problem was corrected by the marketplace without any intervention. And then we had a recovery that lasted all the way until 29. Mm-hmm. Think about Japan. They did the other thing. Their solution were heroic efforts. One massive fiscal and monetary package, a lot of monetary and fiscal coordination, and Japan is still in the throes of a debt deflation. If Japan had done nothing in 1989, followed our example from 1873, which we had to follow because there was no other alternative solution, they would have been out of the problem instead of mired deeper and deeper in the hole.
Well, that's sobering.
Well, no, to me, what's so remarkable about that is, I'm a big fan. A great quote from Bismarck, right? That said, "Only a fool learns from his own mistake. A wise man learns from the mistakes of others." And Japan has been blazing this trail for decades, and very few people seem to focus on the fact that we're doing exactly what they're doing, and getting the same result. I mean, to me, it's one of the bigger failings of the broader economic profession or the policy elites, I suppose. But I guess it's understandable how we get trapped in this. I mean, I guess from your perspective, Dr. Hunt, I mean, maybe if you were in charge and tasked with, fixing the problems we now find ourselves with, I mean, what would be your policy prescription?
Well, I don't do that. I'm in the investment management business, so I'm not going to make policy recommendations.
I understand.
Because I have to live with whatever circumstances. I have a fiduciary responsibility to my clients, and so there's no benefit for me getting into the political debate.
Perfect. Makes perfect
sense.
But
are there mainstream economists who recognize this, who are talking to policymakers? I did read today, I think Nouriel Roubini was talking about this a little bit, but it doesn't seem like there's many economists who are in positions to be talking to policymakers who are saying this stuff.
Well, the consensus opinion is that we can somehow solve the problem by taking on more indebtedness. And I have a famous quote of mine that that I really like, and it comes from none other than Margaret Thatcher, and it's on the consensus. And this is what she said, quote, "The process of abandoning all beliefs, principles, values, and policies in search of something in which no one believes but to which no one objects. The process of avoiding the very issues that have to be solved merely because you cannot get agreement on the way ahead. What great cause would have been fought and won under the banner, quote, I stand for the consensus." So I don't have a problem. I will tell you that we've held a long duration now since 1990. And when the long treasury rates were 9. And when they went to 7, people said they were so low they couldn't go any lower and that you would suffer great capital loss. And then when we went to 5, the rates couldn't go any lower. And then at 4 and at 3. And now they're under 2. And you're pursuing the same type of policies. Trying to understand the consensus or to get agreement from the consensus, in my opinion, is an absolute waste of time.
Well, Dr. Hunt, let me follow up perhaps with the question about falling interest rates. I mean, I'm sure you've seen that we have $16 trillion in the world now of bonds that have negative interest rates. I mean, how do you think about, that trend or the factors behind it, or, I guess how to think about how much lower interest rates could go given some of the facts you're describing?
Well, here is the basic problem. The monetary policy to work has to work through the price mechanism, cooperation with the banks, the rate of growth in money, and the velocity of money. The price variable is the federal funds rate. Well, the federal funds rate is basically at 0. Now, the federal funds rate historically is a lagging indicator. And in fact, from the start of the recession to the low point, the lag time is about 50 months. And moreover, the federal funds rate declines in that time period between 200 and 400 basis points. Mm-hmm. So here we are stuck at the lower bound. The Federal Reserve says that they will not allow the lower bound to be pierced, which means that the most important and powerful weapon that the Federal Reserve has, the price mechanism, is out of the game. Now, in addition, and the chart here illustrates it quite clearly, is that when the marginal revenue product of debt declines, it pulls the velocity of money lower. The marginal revenue product of debt now in the United States is only about 20 cents. We generate only about 20 cents of GDP growth per dollar of debt. And that's pulling down the velocity of money. And so when they engage in these debt finance fiscal operations, the benefit's very slight. And after that, the money supply growth then falls back and the velocity of money declines. And the Fed, in the meantime, cannot lower the federal funds rate because they're at the 0 bound. And so monetary policy's capabilities are asymmetric.
So can we see long rates go negative? And if so, what are the implications of that?
Well, they don't have to go negative. The capital gains will be substantial if they move towards 0. And also keep in mind that economic activity will be underperforming very considerably, just as it has been. In other words, the gap between the potential rate of growth and the actual rate of growth is going to get wider. And by the way, the income and wealth divides will get worse. Mm. And so as a consequence, the downward pressure will continue to persist. And in the meantime, the poor economic performance will at some point in time erode the earnings for the more risky components of the U.S. economy, meaning that the holding of bonds provide a hedge against this scenario and an asset that would do very well if we go into deflation.
Mm-hmm. So, Dr. Hunt, as I'm listening to you again with a fiduciary responsibility to my clients, our clients, I'm hearing longer duration, higher quality. Where does gold play into that in your mind?
I don't. We only confine our recommendations to our asset category. This is in our code of ethics. So we don't engage in the political issues. We don't engage outside our asset class.
Fair enough.
Mm-hmm. Well, Dr., I definitely think it's interesting your perspective that that in so many ways these falling rates are actually driving the wealth inequality and frankly the political kind of divide that's underway. I mean, we certainly completely agree. I guess when I see falling interest rates and I see higher housing prices and essentially affordability of whether it's food products or so much for kind of real, middle class Americans. I mean, I do think those kind of two are linked, and that's one of the things that I guess I kind of would agree with. I mean, so it definitely seems that the track we're on, creates those problems and perhaps attenuates it.
Well, if you look at the last 200 years of data, both interest rates or inflation are lagging economic indicators. In other words, they have to decline well into the expansion. And this was noted in the work of Wesley Clare Mitchell and student Arthur Burns, who I happen to know is chairman of the Fed for part of the time when I was in the Fed. Is not only an empirical fact, but there's a theoretical reason for it. Let's say you go into a deep recession, and as soon as you start coming off the low, the inflation rate begins to rise. Well, then three bad things will happen. Number one, in inflation, prices outstrip wages and real wages fall. That's happening right now.
That's correct.
And so that begins to undermine the ability of the economy to rise. When inflation kicks up, as it has, it resulted in some increase in interest rates from the low point last year to the spring of this year when the rates appear to have peaked. And so what happened was the backup in inflation took the bloom off the rose of the interest sensitive sectors. In addition, when you have higher domestic inflation, firms try to import more goods from overseas because they're generally cheaper, and the trade deficit rises. And so inflation not only is empirically a lagging indicator, but you need the inflation rate to continue falling. And we don't have an example of where a recovery starts and the inflation rate takes off. We have a lot of cases where economies appeared to come out of a recession, but the inflation rate took off and then undermined the ability of the economy to grow. And I think the Federal Reserve was not well advised in the fall of last year when they said that they wanted the inflation rate to go higher, because a lower inflation rate is an essential ingredient of getting an economy out of an economic downturn, because of the precise point that you were making, Lewis, that you need rising real income of your wage earners. And we don't have that now. It's hurting a lot of common folk. So in fact, the way in which the central bank and the fiscal authorities came together produced a transitory benefit, but almost immediately set off a chain of consequences which undermined the efficacy of their moves.
Well, I don't want to change the topic, but I mean, this is really a fascinating point. You may or may not know, Dr. Hunt. I mean, Zev and I have studied the gold markets for a long time. We won't ask you to opine on that. But one of the data points that I've looked at that's very clear is if you look at, let's say, real wages, there was a trend where productivity real wages moved in lockstep with productivity, and that broke like in early 1970, where seemingly something took place, and then productivity advanced and real wages never followed. And that, of course, I would submit anyway, that was the breaking the gold standard. And this is just, I guess, me and my 10-second blurb on that is I think, in my opinion, what really broke at that point was under the gold standard, the wage earners got the benefit of natural deflation through productivity. And when that went away, then a whole host of bad things happened, which forced people to take on more debt. And now we've got an over-indebted situation kind of making it worse. So in my opinion, there is kind of simple things driving these, although it takes a lot of studying, which you've clearly done to kind of figure out. But I would at least.
Well, your analysis is well stated, Lewis. Congratulations.
But, all it took was 20 years of noodling about the concept before I could say it in 20 seconds.
Well, another thing, if you can also see a corollary in the interest rates markets. Debt was originally defined by the Austrian Ergen Bombay work, and he said debt is an increase in current spending in exchange for a decline in future spending. And then Fisher, in the theory of interest, which is critical, it was written in 1930. Which is critical for any bond investor to read. He gave us the Fisher equation and a lot of other critical concepts. He said that he dedicated the book to Bombay work, but he modified Bombay work's definition. And he said, debt is an increase in current spending unless you get an income stream to repay principal and interest. And if you do not do that, then you cause the economy to decline. And in fact, in the 33 econometric article in which Fisher apologized for missing the Great Depression, he said that the velocity of money declines in over-indebted economies. And so what I have been trying to do for a long time is to identify the factors of this complex endogenous variable velocity. In other words, to give the rationale as to why Fisher's point that velocity declines in over-indebted economies is valid. And if you look at the real interest rates today, in other words, the nominal less the real, they are negative. Applying Bombay work, Fisher, what those markets are saying is that real interest rates are justified because the economic outlook is very poor.
No, and let me ask you kind of a historical example, Dr. Hunt. Another way that I've studied this, I don't know this is a topic you and I've ever discussed before, but what's your reaction on this? I mean, empirically, if we can perhaps show viewers, if you can go back, Sam, to that U.S. debt to GDP showing like the peak that took place in the 20s. The peak in the 20s. I'm sorry. Go one or two more. Not that one. I think it's the next one. Okay, great, perfect. So hopefully you can see our screen, Dr. Hunt. So that showed that initial peak in private and public debt to GDP, peaking out at 300 in 1930 when the crash took place. And what's interesting to me, but at least I study the history and love to hear your view on this, is that basically the long-term, the bull market in U.S. in longer dated treasuries didn't end until 1946, which was 17 years after the peak in 29. And I guess what I found interesting about that was this concept of kind of deleveraging being people taking current consumption and putting it into the future. The exact opposite of the act of going into debt, right? And so I was wanting, I guess, so in my own mind, as I thought about what the bond market might hold, one way in my own mind that I thought about this is, well, almost like you could be bullish on the outlook for long-term bonds until we stop deleveraging. If you just
that point is very, very well taken. Remember, I quoted earlier the McKinsey studies of these 24 advanced economies that became extremely over-indebted, and McKinsey said that it had to be solved by austerity. One of the 24 cases is the U.S. in the 1920s and 1930s. Yeah. And many people don't realize this, but World War II was a period of extreme austerity. We had a tremendous surge in our exports, but we had mandatory rationing. That's right. So to fight World War II, we ran a budget deficit of 14% of GDP, which was the record until last year. We passed the record deficit in percent of GDP that we had during World War II. But what was different was that private saving was 27% of GDP. In other words, if you were paid, but you could not buy things. We had, if you wanted to buy 4 tires, you might be able to buy 1. You couldn't buy an automobile. If you wanted 10 pounds of sugar, maybe you could buy 1. And so we had forced saving. And so what World War II did is that it allowed us to pay off the excessive indebtedness of the 20s and 30s. And unfortunately, last year, people say, well, didn't we get escape volume from the fact that we had a record budget deficit to GDP? The difference this time was that the private saving did not compensate for the deterioration in government dissaving. And so we have not solved the problem. Well, the World War II case was a prime example of austerity, and it's one of the 24 cases in McKinsey's work. And I recommend everyone to read their work.
Well, so Dr. Hunt, do you think that's one reasonable framework to think about it is, as you've said in the past, if kind of like the act of going into debt right now can temporarily boost consumption, but it subtracts from future growth if you think about the concept of time. So if we do have to delever, I mean, if we lose future demand, if we're losing future demand or weak demand through re-leveraging and over-leveraging, and if growth kind of suffers when we deleverage, that's kind of basically a long-term forecast for weak growth, isn't it? Or is there another way to think about it?
It is. The risk is that those that advocate command and control economy will want to change the basic system.
Yeah.
They'll reach the conclusion that debt by itself doesn't work. Now, when we left the gold standard in 1933, we created a central bank that would be the lender of last resort, not the spender of last resort. The Federal Reserve's liabilities are not medium of exchange, store of value, or unit of account. But there are people that would like to make the central bank's liabilities legal tender. Now, this is what Germany did after World War I. This is what the Chiang Kai-shek government did in China in 1935. There was a case in Hungary and Yugoslavia at the end of World War II. We have two cases in Latin America today. And if you take that additional horrific step, in other words, if you make the central bank of the US a banana republic bank, you make the Fed the spender of last resort, then you will trigger Gresham's law. You will chase the bad money out of the bad money will chase the good money out of existence. You will get rampant inflation, and in that case, you will make everyone even worse off than we are today.
So you don't like to opine on politics, but so what do you think the chances of that happening are? I guess you're not going to answer the question.
All right. Well, the present chairman of the Federal Reserve Board he has said that he opposes making the Fed lender of last resort, but we don't know whether he's going to be reappointed or not. The Federal Reserve Act would have to be amended. Could it be amended next year in front of the national elections? I don't think so, but I'm not a politician. I don't know. For the Federal Reserve Act to be amended to give the Fed's liabilities legal tender status, you have to push it through the Congress. The Fed has to lead that role. And it would have a tremendous adverse effect on the financial intermediaries and a lot of other sectors. And by the way,
so the banks wouldn't want that to happen, is what you're saying. The banks would be,
I'm sorry?
What you're saying is the banks would be against that.
They would. It would absolutely be, it would be a near ruinous situation for the banks. And inflations, as well as slow growth, the burden falls on the weaker components of our society. That's sadly the fact. But the inflationary impact on the weaker segments is greater. And so the inflation rate would tick off, everything would become more miserable. And so the real issue here is whether we keep the current system with all of its problems or go to an even worse system that would produce results. One of the reasons, I didn't elaborate on this, as to why the debt is undermining economic growth. When the central bank and the federal government coordinate, which we saw last year, and keep in mind, this was not the intent. The central bank was supposed to be independent, but when they coordinate by taking on massive amounts more of debt, what this in effect does is this increases the government role in the economy. In other words, it moves us further and further into command and control economies. All right, well, what happens in command and control economies? The political process allocates more and more resources to the low multiplier governmental components of the economy and shifts resources away from the high multiplier private sector. So the advocates of this system, when they realize that the taking on of debt by itself is not workable, they may try to go in an experimental way that would be even more disastrous. And the way that I've sort of summarized it is I've quoted the Hollow Men by T.S. Eliot. And Eliot in the poem said, "How does the world end? How does the world end? Does it end with a bang or with a whimper?" If we go down the path of indebtedness, we end with a whimper. We get death by slow strangulation. But if the path toward lowest strangulation leads us to making the central bank the spender of last resort, then we end with a bang, an inflationary bang.
Well, and Dr. Hunt, on that point, I might guide us to the last set of questions, Sam, that we had on our deck. And you were kind enough to hit on this one straightforward, which is, what would lead you to change your mind? And that's, of course, like a hyperinflation situation. You outlined the, how that would be, ruinous for many things. And so your investing framework has got kind of a bright line there in terms of watching for that aspect. I guess another one in terms of thinking about—
I wouldn't use the term bright line aspect. It's an alternative aspect.
well, okay, I'm sorry. Let me rephrase that. Is it basically you could be described as somebody who's bullish on the outlook for long-term bonds, and that if that set of policy subscriptions took place, your view would change dramatically? Is that fair to say?
Or if we deleveraged, if we found a way to deleverage.
Perfect. Well, let me ask you kind of another kind of hypothetical question about the future, and I guess, and that has to do with taxes. There's a lot of talk and debate in terms of what might happen in terms of future taxes. I know you've done a lot of work on the economic or econometric impact of that. So right now, it seems like our policymakers are bent on kind of raising taxes. I mean, if taxes, income taxes, for instance, do go up, what kind of impact can we expect on the economy? Okay,
so what we have. And of course, we don't know whether this is going to pass or not. We basically have $3.5 trillion worth of new spending. And we have that offset by about $1.8 trillion of tax increases, which means that we're going to have to issue another almost $2 trillion more of debt. Well, for me, the implications of the debt are clear. However, the spending increases will occur very, very slowly over time. Infrastructure projects, they are so slow. I mean, you have to get coordination between the state governments, local governments, federal. Then you have to do the engineering studies. You have to get the environmental clearance. Then you have to require the right of way or what have you. That's a very, very slow process. So you borrow the funds, and but it comes in slowly. But in the meantime, the tax increases are going to take effect immediately. In fact, if the tax bill passes, as I understand it, the capital gains tax increase applies to everything after September 13th of this year.
Yes.
And so the main effect of this bill on the economy near term are the tax increases. Then the longer term, you take on more debt, the spending comes in as you build up the debt, and that also produces weaker economic growth. It is not a solution, in my opinion. It may be politically popular. It may be what the country wants to do. I'm not going to comment on that, but it's not going to be a solution to our problems.
Got it. Well, I tell you, Dr. Hunt, just like we said the other day, we could talk for literally hours about this topic. You know, it's so rare, you know, for us to get the opportunity to have an expert of you know, your magnitude in terms of the amazing work you've done. And it's very kind, you know, before I hit on the takeaways, we should say that you're kind enough to share your insights there at Hoisington on a quarterly basis. And I read them religiously, and I'd recommend everybody that wants to educate themselves about thinking about bonds should always take advantage of you sharing your insights. So thank you very much for doing that.
My pleasure. Nice to be with you, Lewis.
Yeah, and I echo that, Dr. Hunt. So today, as we think about our takeaways, interest rates been falling globally for the last 40 years. I think you've probably followed our writing and our comments on this over the past. It's driving capital appreciation lower for long duration bonds. Will that trend continue? We believe it will. Why? Because over-indebtedness is poisoning the economic growth and keeping bond yields low. I think as we shared today, negative doesn't have to be the final answer, but lower has capital appreciation from where we are today. And we think longer dated high quality bonds are an important part of our diversified portfolio, which we feel is a very important part of our asset allocation. Dr. Hunt, it has been a pleasure to have you. We hope to see you in Naples soon. And we appreciate everybody being on today. We got an enormous amount of questions, so we'll be answering a number of questions directly online. I really want to say how thankful we are that you've been participating today with your questions. We will get to each and every one of them offline today, but we want to try to hold us to an hour. We know everybody's time is valuable. And again, thanks, Dr. Hunt, Lewis, Zev. Appreciate your time today, and we look forward to talking to you next month. If you have an opportunity, please fill out the exit survey with your opinions. Have a great day.
Bye, everybody.